Welcome to the deep dive. Today we're digging into your sources on a story that, well, it isn't exactly front page news, but it really has the potential to fundamentally reshape global finance as we know it.
Yeah.
Our mission today is to unpack China's systematic, long-term strategy to build this parallel gold-backed financial system.
It really is a historic pivot point when you actually look at the sources, the data.
Yeah.
You see this is way more sophisticated than just, countries hedging against inflation with gold.
Right, it's not just a simple debasement trade.
No, not at all. This is about strategy, it's about trust, even manipulating regulations and deliberately building like whole new financial plumbing.
Plumbing designed to challenge the US dollar's role.
Exactly. Its status as the world's reserve currency.
Okay, so we're looking at a really high-stakes game here. Geopolitical, economic chess played out over, 200 trading days and across continents.
That's a good way to put it.
We're going to guide you through the what and, crucially, the why behind this accelerating shift away from relying solely on the dollar.
And to really get the gravity of this move, you have to remember the foundation of the whole post-World War II system.
Trust. Primarily trust in the US dollar.
Exactly. Trust in the dollar.
Hmm.
For decades, I mean, U.S. Treasuries were seen as the safest assets, period. You had something like, 70% of all global reserves nations' savings parked in dollars and U.S. assets.
That gave the US just immense financial power, almost unquestioned.
It did. It was the bedrock.
But, as your sources highlight, even bedrock can crack.
It sure can.
Yeah.
And here's where it gets, really interesting. That foundation, it started to visibly erode, and pretty dramatically back in 2022.
Right, when the U.S. and its allies decided to freeze Russia's foreign reserves, about $300 billion worth.
That's the one. That actually, I mean, whatever your politics are, it sent this huge, undeniable signal across the globe. Every capital city was watching.
It basically telegraphed that dollar reserves weren't truly sovereign.
Precisely. It told every non-aligned nation, every emerging market, that, hey, those reserves you hold in dollars or treasuries, they aren't actually yours, not completely. They could be seized, locked up, weaponized, basically with a keystroke.
So that implicit guarantee that your national savings were safe from politics just vanished.
It evaporated instantly. And, when trust in paper assets goes poof.
The reaction is pretty logical. You look for something tangible.
It was immediate. Central banks all over the world, but especially in the developing world, they hit the accelerator on selling U.S. assets.
Dumping treasuries.
Yeah, lowering their exposure and shifting that capital into the one asset you really can't seize remotely or print more of, physical gold. That loss of faith, that was the catalyst.
And leading this new gold rush by a huge margin has been China.
Absolutely. The People's Bank of China, the PBOC, they've become the world's biggest gold buyer in recent years.
And often funding it by selling off their U.S. Treasury bonds, right?
Explicitly. Drawing down their treasury holdings to buy gold. But, the sheer scale of their buying,
Yeah.
it's only half the picture.
Okay. What's the other half?
The visibility. Why do it so publicly? I mean, if China just wanted to diversify its reserves, they could buy gold quietly, right? Through intermediaries, keep it low-key.
But they're not. They're making it very obvious, even if it drives the price up a bit for them.
Exactly. Because it's not just about hoarding gold. It's about sending a message. Broadcasting confidence.
A signal to other countries.
Precisely. They're using their buying to telegraph, especially to BRICS nations, countries in Africa.
Look at the verifiable physical collateral we have. We're moving off the dollar system. You can too. Join us.
And some sources pointed out the timing, right? This public buying ramped up significantly after the U.S. tariff threats started.
You can see it on the charts. It
Yeah.
became this sort of economic shield, but also a strategic advertisement. Like, we're preparing for a different world. And it seems like that message is landing. The dollar's share of global reserves keeps dropping. It's at lows we haven't seen in decades.
It is.
Now, China's official gold holdings, the reported number is around, 2,300 tons? Sounds big, but what's the real story?
Well, that's just what the PBOC officially admits to. But when you start adding in the gold held by their big state-owned banks, their sovereign wealth funds, groups like Bloomberg Economics, the World Gold Council, they estimate the real number is probably much higher.
How much higher?
We could be talking closer to 3,500, maybe even 5,000 tons. That's a staggering amount of power being concentrated in physical, verifiable stuff, not just paper promises.
And they're not just stacking bars in a vault somewhere, they're actually building the marketplace, the infrastructure to use it.
That's absolutely key. They built the Shanghai Gold Exchange, the SGE. It's already the world's biggest market for physical gold. And crucially, They just opened a big new vault in Hong Kong, also verifiable.
Why Hong Kong?
It adds another layer, facilitates international access, and reinforces that this isn't just domestic. It's all designed for rapid physical movement, trading, verifying gold bars, making it liquid, usable.
Okay, so that infrastructure then enables the second big part of their strategy, which is actually unlocking gold's financial power through regulations.
Right.
Because for ages, gold was just, it sat there, shiny, expensive, but banks couldn't really use it to power finance, right? Why was that?
Yeah, it was kind of a dead asset on bank balance sheets. It goes back to the old banking rules, the Basel Accords. Under the old system, gold was a Tier 3 asset.
Tier 3. What does that mean, practically?
It meant, say, a big bank held $1 billion worth of gold. They could only count about half of that $500 million towards their mandatory capital reserve.
Okay, so a built-in penalty compared to something like treasuries.
Exactly. It structurally discouraged banks from holding gold. If you're a bank CEO focused on efficiency and meeting regulations, you'd always prefer treasuries, which counted at 100% value. The whole system was kind of rigged towards paper.
But that's changed now, or changing very soon.
It has fundamentally changed. As of July 2025, that's this year, gold officially became a Basel III Tier 1 asset.
Tier 1. Same level as cash and treasuries.
Pretty much.
Yeah.
It means banks can now recognize 100% of its value on their balance sheets for capital adequacy. Suddenly, gold's on a level playing field, regulatorily speaking. That historical handicap, gone.
That's huge, psychologically and practically. But the sources we read suggest the real game changer is the next step, turning gold from just a recognized asset into, well, an active financial tool to compete directly with the dollar.
That's the push for HQLA status, high-quality liquid asset.
HQLA. Okay, break that down. Why is HQLA so important?
Think of HQLA as the absolute gold standard, no pun intended, for collateral in the financial system's plumbing. Right now, that status belongs almost exclusively to U.S. Treasuries.
And this HQLA collateral is what fuels the repo market.
Exactly. The repo market is like the central nervous system for global liquidity. It's where banks and institutions do massive amounts of short-term borrowing and lending, using HQLA like treasuries as collateral. It keeps everything stable, day to day.
So if you're a country wanting to fund a huge project, like a power grid or a port,
You need access to that repo market, which means you need assets recognized as HQLA to pledge as collateral, which until now mostly meant needing U.S. dollars in treasuries.
okay, so if gold gets HQLA status,
Oh,
countries wouldn't need to stockpile dollars just to finance their own development anymore?
correct. It completely changes the game. Gold transforms from just sitting there looking valuable into a mobile, active financial instrument. It could be used to borrow, lend, fund massive infrastructure projects entirely outside the dollar system.
And that is the ultimate goal for China, bypassing the whole Western financial setup.
That seems to be the end game.
Which brings us neatly to the BRICS nations. How does China convince allies like Brazil, India, South Africa to actually use this new yuan-based system? They face two big challenges, right? First one, trust.
A huge one. These countries saw exactly what happened with Russia's reserves. Why on earth would Brazil or India trust China or any single nation really to hold their foundational gold collateral in a vault in Shanghai?
Yeah, China would just become the new gatekeeper, the new power broker. Same problem, different flag.
Right. So China needed a different solution, a decentralized one, and that's where they came up with the gold corridor.
The gold corridor. Explain that.
This is where it gets really innovative, I think. It's basically a network of new, highly secure, verifiable gold vault built across the BRICS countries themselves. But they're all digitally linked into the Shanghai Gold Exchange system.
So distributed custody, not all eggs in one basket in China.
Exactly. It's a decentralized custody model. One source actually joked it's like an analog blockchain, verified by nations, a Fred Flintstone chain.
Huh, I like that. So the physical gold bar might be sitting in a vault in, say, Mumbai or Sao Paulo.
Correct. Its purity, serial number, ownership, all tracked across this network. But because it's linked to the SGE, it can still be used instantly as collateral on the platform.
That solves the trust issue. Your gold stays geographically dispersed, maybe even in your own country, but it's still financially active globally through the SGE.
Precisely. Geographically decentralized, verifiable, redeemable, auditable. It assures the BRICS partners their collateral isn't under someone else's thumb. Trust problem potentially solved.
Okay, brilliant. But that leaves the second big problem, volatility. Gold prices jump around, sometimes wildly. How do you secure a 20-year loan for a dam based on collateral that could drop 5% next week?
Yeah, that price risk is a killer for long-term financing. They needed stability.
So how did they tackle the volatility?
With a pretty straightforward but effective pricing mechanism for settlement, instead of using the daily spot price, which bounces all over the place.
Prone to speculation and short-term noise.
Right. They propose using a moving average for the settlement price. For example, averaging the gold price over, say, the last 200 trading days.
Okay, a 200-day moving average? Why does that simple tweak make such a difference?
Because it smooths everything out. It filters out the daily noise, the peaks, the troughs. For those long-term deals, like that 20-year dam project, both the lender and the borrower are protected from sudden market panics or manipulation.
It makes the settlement value of the gold predictable over the medium term.
Exactly. Predictable enough to form a stable foundation for issuing massive long-term credit. Volatility problem managed.
So all these pieces, the decentralized vaults, the stable pricing, the push for HQLA status, it all seems to lead to one place, bypassing the IMF and the World Bank.
That appears to be the ultimate goal, yes. The endgame flow looks something like this. China, probably using the BRICS-led New Development Bank, starts issuing loans in yuan.
To developing nations, especially in Africa maybe, those rich in resources or gold.
That seems likely. And in return for the yuan loan, the developing nation deposits its physical gold into this new gold corridor network as collateral.
So China gets to fund infrastructure projects, roads, ports, power plants, which builds huge global influence.
And simultaneously, they're accumulating verifiable physical gold collateral, pulling it out of the dollar system and into their own sphere.
And importantly, offering development funding potentially without the strict conditions often imposed by the IMF or World Bank.
That's a key attraction. It meets desperate development needs and builds a gold-backed zone of influence, sidestepping the entire Western financial architecture.
Now, if this shift towards physical gold as the ultimate collateral is really happening, the U.S. reaction becomes really interesting. Your sources mention the U.S. quietly started repatriating its own gold earlier this year from places like London.
Yeah, the official reasons given were pretty low-key administrative stuff. But if you look at it through this strategic lens,
It looks different.
it looks critical. The theory is the U.S. knows the game is shifting towards physical collateral, towards a system where gold actually has to exist and move. And if physical control is paramount, then the U.S. needs its own massive gold stash, estimated around 8,000 tons, back under direct U.S. control.
Not sitting in a vault overseas where geopolitics could theoretically interfere someday.
Exactly. Custody becomes the ultimate measure of financial power in this new world. Getting your gold home might be a crucial defensive play.
Okay, let's pivot to market impact. If this new gold-centric system really takes off, what does that do to the price of gold itself?
Well, just the regulatory shift, gold becoming Tier 1, creates significant new demand right there. You're already seeing major banks, like Bank of America, putting out research suggesting central banks and sovereign wealth funds should up their gold allocation.
From what, around 20% now?
Yeah, the current average is around 20%. The recommendations are pushing closer to 30%.
That 10% difference doesn't sound like much until you apply it to trillions in global reserves.
It's absolutely monumental. That 10 percentage point shift translates into estimated demand for something like $2 trillion worth of new gold globally.
Wow, $2 trillion.
And here's the thing. You can't just print more gold. Unlike paper currency, the supply is finite and grows very slowly. So when you inject that kind of massive sustained demand into a tight market,
The price has to adjust
Yep.
significantly.
you're looking at a potential major repricing. Some of the sources we looked at predict gold could easily double in price over the next, say, 5 to 7 years, based just on these systemic shifts.
So what we're really seeing is the start of a kind of monetary schism, right? A fork in the road for global finance.
That's a good way to describe it.
Mm-hmm.
You have China and the BRICS bloc building a system based on physical, hard collateral, gold. Trust built through time, through tangibility, through verification.
And then you have the U.S. and the West, who've dominated the credit and paper-based system.
Hmm.
They have to respond somehow.
Right. And their response might lean more into technology, maybe programmable assets, central bank digital currencies, perhaps stable coins, maybe even leveraging things like Bitcoin. Trust through, what, energy and math and transparency.
So it's a real competition of ideas about what money is in the 21st century. China, emphasizing control, hard assets. The West, potentially emphasizing technological efficiency, maybe openness, speed.
It really looks like we're entering what some call a multi-monetary phase of history.
Right.
Governments are actively competing, and individuals, companies, even countries might soon get to choose which system, which idea of money they trust more.
And that competition itself, just the uncertainty and the shift, could drive rapid repricing in both gold and potentially some of these digital assets, though rapid here means maybe 5, 10 years on this scale.
Absolutely. The market is effectively trying to figure out which system is more resilient, more reliable for the future. That process alone creates volatility and repricing pressure.
Okay, so wrapping this up, what does this all mean for you, our listener? We've definitely moved way beyond just talking about gold as a simple hedge against inflation.
Yeah, we've outlined this really systematic, gold-backed strategy from China, one that seems cleverly designed to solve those core problems of trust and volatility, aiming to create a genuine parallel financial system.
This deep dive really shows how, I guess, the very foundations of global finance are being quietly renegotiated. And it's all coming down to trust and who controls the verifiable collateral.
For the first time in generations, really, we're seeing genuine structural competition in the monetary sphere.
Mm.
And it's not being fought, with armies, but with gold bars, regulatory filings, and financial plumbing.
Okay, so here's a final thought for you to chew on based on everything we've discussed. If physical control, local control of gold really is becoming the new bedrock of global lending power, does that make the U.S. decision to bring its gold home from London the single most important and probably the least talked about defensive move in this entire high-stakes game?
Something to think about.
We'll leave you with that. Thanks for joining us on the Deep Dive.